Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Randy Frederick, Vice President of Trading and Derivatives with the Schwab Center for Financial Research at Charles Schwab, to discuss what volatility and other indicators are pricing in for the 2020 U.S. election. Randy, it's great to see you as always. Welcome back to Trade Talks. And before we get into volatility markets, it's going to be quite a week for us, that's for sure. But let's first review presidential performance. As you pointed out in Friday's blog, since 1932, the S&P 500 has aggregated 710% return under Democrat presidents and 375% under Republican presidents. But tell us what the key takeaway is for investors.
Yeah, the key takeaway, and the reason we focus on these all the time, is that sometimes investors get in a mindset where they have to make very giant changes, and they get in sort of these extreme things like, I either need to be 100% in the market or all cash, or I should buy all gold, or all these kind of crazy sort of extreme type things. And we don't really want people to do that. It's important for people to be invested in the market, and it's important for them to be in the market for the long run. So pointing out the difference between how markets have performed under Republican presidents versus Democratic presidents is not there to help them make a decision on whether they want to be in or out based on who they think might win. But the important point is the one you haven't mentioned yet, which is what happens if you had been in the market that entire time, not just during the Republicans and then you sat in cash during the the Democratic presidents, or vice versa. And the reality is it's a monstrous number. It's like 45,000%. We're talking about an increase in the S&P 500 from like 7 to 3,200. And if you do that number, you're going to do that calculation 2 or 3 times because you're not going to believe that it's actually right, especially when you compare it to what would have happened under either of the other two. And the main point is that no matter what you think might happen, no matter whether you're worried about an increase in taxes or you're scared that we might become socialist or any other kind of an extreme idea, the most important thing is to stay in the market. Now, if you want to make small changes, maybe take 2 or 3 or 5% off the table and pay some taxes because maybe you're concerned about an increase in capital gains tax. Nothing wrong with that. Just don't make huge, drastic changes.
How does the S&P 500 look similar to 2009?
Remarkably, that's how. It's pretty incredible. In fact, this is a correlation that I first sort of came across just by accident, just looking at charts, because I do that every day. Way back in about March or April, I noticed that the rebound off of the COVID bear market, the very quick, brief one that we had, was remarkably similar and sharp and V-shaped, if you will, to the one that happened in March of 2009. And so I started to watch the two, and it was pretty remarkable because every time I looked at where the market went and how far up it went and how long it took back in 2009, I noticed that in 2020, the S&P was tracking almost exactly the same pattern. And so I started calling this the 2009 roadmap. And I waited every month for it to break down, and it really never did. Now, there are a couple of very brief periods for maybe a week, 2 at the most, where they might have diverged a little bit, but then they very shortly got back in line with each other. And even up to now, in fact, back on October the 1st, when we had just gone through that downturn that we had in September, I put out a tweet and I said, basically, it looks like we have one more downturn to go, and it's probably going to arrive about a week before the election. That's exactly what happened. Even I didn't think it would be that accurate. It's remarkable. You can lay those two on top of each other. I've never seen 2 completely different charts that are so closely correlated. And I don't play any tricks like some people will do. I'm showing an exact year from January 1 to 12/31, and I scaled the y-axis not by numbers because you can't do that, but by percentages. So it's exactly the same percentage. That's the only way you can compare 2 markets that are at different levels. It is pretty remarkable. So that being the case, we don't make year-end predictions, but if that pattern were to continue for another couple of months, that means we could potentially see the S&P 500 up around that 3,700 range by year-end, which is pretty good. From here, I think that's about a 14% gain. That's pretty strong, but certainly we've had 2-month periods before where it's gone that much.
That's right, the good old 666 bottom back in March 2009. So let's talk about the VIX and VIX futures. What observations are you making in the volatility markets, and what does that imply about the election?
So a lot of really interesting things have been happening there. So we can go all the way back to February of this year when the VIX futures for October, November first became available, and there was a very noticeable spike in the price. And that obviously we knew even as far back as then, this is even before we had the bear market, that there was concern about a big jump in volatility around this election. Throughout the rest of the year, even as the market went down and even as the volatility curve itself shifted up and down as things got a little crazy, certainly back in the spring, that spike remained out there. Interestingly, what that means is that there's been sort of it's kind of been I don't know if you want to call it a conventional wisdom or just a crowded trade for a very, very long time that we were going to get a spike in volatility around the election. Well, interestingly enough, just in about the past 2 weeks or so, that trade had gotten so crowded that the pricing difference between the buying calls on volatility versus buying puts had gotten astronomically wide. In other words, calls were exceedingly expensive, whereas puts got really, really, really cheap. So they got so cheap and so compelling that enough people saw them that they started to buy up the puts because, hey, what if just by chance this election goes very smoothly? Certainly that's not the base case, but it's not impossible. What if there is a landslide victory from either direction? And by the end of the day on election day, tomorrow, we know who the victor is, and it's very clear, and the transfer of power is very smooth. Again, I don't think that's the base case, but there's certainly a possibility. And so they've started buying up the puts. Well, interestingly enough, then what happened over the last 2.5 weeks is that started to drive the price of those puts way back up. So that now we are in a situation where it appears as though there's a mixed bag. You got a pretty sizable contingent of people out there who are convinced that volatility is going to continue to go higher, and it's going to remain higher for maybe several weeks, if not a couple of months after the election. And you've got another big contingent of people who are thinking, hey, things are probably not going to be as bad as everybody has thought for the last several months, and volatility is going to come right back down. So I'm curious to find out who's right. It was pretty one-sided there for a while until about the last 2 weeks. And, you know how the second half of October went, not so well. The market went down, volatility went up. Now we're in a situation which is kind of unique. We're in a backwardation phase. And I know you know what that means, that the VIX itself is trading at a higher level than the futures are going out several months. And that means that we're probably going to see the VIX come down a little bit, but it's probably also going to trickle off a lot slower after the election than what it typically does. That's assuming the futures are right, but there's a pretty good amount of trades going on out there that are saying maybe the futures aren't right. So it's going to be interesting either way you look at it.
Yeah, it definitely is, Randy. And you made a great point in your piece on Friday as well, that you can't remember a time when there was this much disagreement when you look at across market indicators across the board. There's a lot of if or these things could happen, not happen. It just seems as if there's a lot going on and there's not many indicators in concert with each other.
Yeah, so I look at like 16, 17 different indicators every Friday, and I put that report together, and they don't always all agree. In fact, most times they don't completely agree. But you might have some that are really bullish and some that are just moderately bullish and a few that are neutral. But you don't often have extreme bullishness and extreme bearishness at the exact same time. And if you do, it's like one indicator. We got several that are both directions right now. So it is a high level of disagreement. And you've got some extremes and other things that you just don't see very often. So for example, just last week, in fact, early in the week, we had put call ratios on the VIX that were the highest in history. We've only had options to could trade on the actual cash options you could trade on the VIX. Only go back about 12 years. We were at the highest put call ratio that's ever existed in that 12-year period. That's pretty extreme. So again, those are the people who are convinced that volatility is going to fall off quickly after the event, like it normally would, rather than stick around like the futures have been telling us for a long time. And then at the same time, you've got all these people who are still convinced that we're going to have a major calamity of some sort. I don't know if that's violence. I don't know if that's a refusal on whomever loses to concede the election. I don't know what it is that they think, but they're convinced that volatility is going to go way higher than where it is right now. And so those people are very bearish. So it's fascinating to see. And yes, while you do get some disagreement all the time, the extremes in both directions right now are pretty dramatic, almost kind of like the political extremes that we're living in.
Yep, it really is quite remarkable. Randy, as always, thanks so much for joining us on Trade Talks.
You're welcome, Jill. Always great to be back with you.
Great. Thank you so much. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.